after becoming the first major central bank to pause after the string of interest rate rises. This week, Reserve Bank Governor Philip Lowe outlined his strategy to try and glide Australia's economy to a soft landing. But it has risks, especially if inflation is more persistent than expected. Edward Boyd reports on the RBA's delicate balancing act.
At the National Press Club this week, Philip Lowe made it clear that saving jobs while trying to reduce inflation is the mantra.
Our central view, though, remains that economic growth will be below trend for a while, that unemployment will increase later this year, and inflation will decline gradually over time.
But there is risk. If inflation doesn't fall quickly enough, the governor vows he will crush it by raising interest rates sharply.
If we need to keep interest rates high for longer to make sure that inflation comes back to 2 to 3% reasonable range, reasonable time, we'll do that.
Oddly, this is quite a different approach to that being taken by other central banks, notably his Kiwi counterpart Adrian Orr, who this week raised New Zealand's cash rate 0.5% to 5.25%. And that, remember, compares with Australia's cash rate of 3.6%. But money markets think Lowe's strategy will persist for now. The markets price in just a 6% chance of an interest rate hike next month, a 94% chance of rates being on hold.
They've probably got one more rate hike in the back of their minds that they think they'll need to deliver just to get that rate of inflation down. It's not a done deal, though, whether or not they move again in May. We think they've put so much through that the economy will slow sufficiently this year to actually see the rate of inflation come down, particularly when you couple that with the fact that wages growth is currently consistent with the inflation target, which is a good news story.
The key data is the March quarter inflation figure, which is released in about 2 weeks. It will give a snapshot about whether the cost of living is slowing fast enough for the RBA.
Where we think the disinflationary pressures will come, and in some pockets outright deflation, in other words price falls, is in parts of the consumer discretionary basket where households are going to have to rein in spending in order to meet the higher mortgage repayments. And therefore businesses in those sectors won't be able to get away with continuing to put up prices. And we think in certain parts of the retail sector, you'll actually see some discounting.
Along with rising oil prices and rents, the other danger Philip Lowe is keen to avoid is excessive wage hikes, which could entrench inflation and higher interest rates for longer.
Looking forward, it's important that wage increases remain broadly consistent with the inflation target, and that a widening of profit margins does not become a source of ongoing upward pressure on prices.
I think the commodity story you can look through. I think if you get a spike in oil prices, you could say, look, unless it gets through to inflation expectations, unless it embeds itself in the economy, it's less important than the wages story. That's a critical feature of why I think the RBA has been able to move more slowly than other central banks. We've gone 350, the RBNZ's gone 475, the Fed's gone more, the ECB is likely to go more as well. Why? Because they've got a bigger wages problem than we've got. We've seen a pickup in wages growth, but it hasn't yet gotten to uncomfortably high levels. And so that is affording the RBA the opportunity to be able to take it a bit easier, try to protect some of those jobs.